Hi, everybody. Today we kickstart yet another news series, The View from Wall Street. Indian markets are on the threshold of their big festival season and the traditional busy season, but India ultimately follows global trends. Hence, we are cementing our Diwali offering this time with a view from Wall Street. We kickstart this series with Brian Jacobsen, who is the senior investment strategist on the multi-asset solutions team at Wells Fargo Asset Management. Brian, thank you very much indeed for joining us and kickstarting a very important series for us. Well, first up, we are in the midst of a very tumultuous and uncertain election season in the world's largest economy. Then why are markets surging?
It is rather interesting. So going into the election, we thought that the market was pricing in a blue wave scenario. And so for us, that generally means that the Democrats would take control of the Senate, which was under Republican control, retain control of the House, and then also take control of the White House. And then it became quite apparent that instead of getting a blue wave, we're actually getting, you could call it a kind of purple rain, because it's a mix of the blue for the Democrats and the red for the Republicans, which is really a formula for gridlock. And so the market reaction really, I think, suggests that people were very cautiously positioned going into the election. They just wanted to see what was going to happen. Was there going to be chaos, rioting in the streets, things like that? You had all these worst case scenarios. And so I think it's just a little bit of a relief rally. And not just because we have the election almost behind us, because we're still waiting on some results, but also relief that it likely means some gridlock going forward. So that really means that there's still a chance of some stimulus spending, although probably at a smaller size than what it was a blue wave, but then also probably no tax increases for the next at least 2 years until we get to midterm elections, and then we have to see what happens with the balance of power in Congress again.
That was what people led us to expect, that it'll be a smaller stimulus because of the gridlock. But more generally, we have been seeing the dollar weakening, but every time it comes to 92, 92 and a half, we see it strengthening again. Now, with this backdrop of maybe slightly smaller than expected stimulus, how do you see the dollar in the next quarter and in the next 12 months?
Yeah, our anticipation is that the dollar, as you point out, that it seems to any time it gets to around 92 and a half, that it kind of recovers from there, that there's probably good technical support at those levels, but then there's also probably some fundamental support. Near term, we're a little bit indifferent towards strengthening or weakening because it's a bit of a mixed bag. I think that we saw some strengthening when there was expectation that you could get faster economic growth in the United States. And if there isn't as much fiscal stimulus coming, maybe people are going to reconsider that, whether or not we're going to see that type of strength in the economy to strengthen the dollar as well. But over the more medium term, so if we're looking out, say, 3 months beyond, we think that there actually is some fairly good fundamental support for a slightly stronger dollar as opposed to a weaker dollar. Some of that is because with less fiscal support, you also will have less issuance of Treasury securities going forward, and that would tend to depreciate the dollar. So we're somewhat neutral in terms of positioning with the dollar.
Okay, if there is a mild strengthening, then it would not be very favorable for emerging markets. How are you looking at emerging markets, the currencies, and the Indian rupee, if you're tracking it?
When it comes to the emerging market currencies, obviously a stronger dollar means that it's weaker other currencies. And then also if you have an emerging market that has issued a lot of debt in a hard currency or in US dollars, that can be a real burden on those economies. Now, thankfully, we don't think that the dollar is going to strengthen too much such that it would become too much of a burden on any emerging market that has issued dollar-denominated debt. Oftentimes, it's going to be driven more by those local economies as far as their political issues and their economic conditions. So when we look at a country like India, for a while, obviously, the coronavirus crisis, it hurt all countries. India looked like it was really difficult, but it has a young population, and it seems like it's bouncing back pretty nicely from that coronavirus crisis. So there could be enough economic strength there, fundamental strength, to really support the rupee going forward.
Okay, you said that there's possibly a near-term dollar strength. That's usually negative for emerging market flows. Now, actually, EMs have been getting flows in the past few weeks and months. How do you see these flows in the second half?
Is possibly in danger in the near term. Our portfolio positioning has been one where, as a result of the elections and seeing what's been going on with the markets, it is almost like what happened and the ramp up in markets coming out of the March 23rd lows. Everything sort of rose, but the U.S., especially large cap tech, really dominated things. And at least for the near term, we think that trend can continue. So we've been positioning portfolios more sort of neutral with our emerging market exposure, and us also then having a bias towards, the more tech-heavy NASDAQ as opposed to the broader-based S&P 500. But that is very much a tactical call on our part. We're looking for an opportunity to rotate into more cyclicals, so small cap, value, and emerging markets. We think that day is coming, but it is likely going to have to wait until probably sometime into the new year or getting close to it, when there's a little bit more clarity as to when there's going to be a vaccine that's more widely available. Because as much as we'd like to think that the hope of a vaccine can help push the markets further, there's likely going to be some disappointing economic data globally as we see renewed restrictions in European economies, rising cases in the United States, because people can't really take a vaccine. They're not going to re-engage in more normal activities on the basis of hope. They're going to actually wait until they're vaccinated to do it. So we think that right now, the short-term trend is kind of your friend as far as with large cap tech in the United States, but that there is going to be an opportunity within the next few months to rotate into emerging markets and then also into the smaller cap and more value names in the United States.
All right, I'll take you on that. Since you're going to rotate back to emerging markets, what would be your pecking order?
So within the emerging markets, if we think about it just sort of very much regionally, right, you have the Asia Pacific region, which is very much dominated by China. That's been sort of the biggest component there. And the valuations there are fairly high, but we think that it's actually high for a good reason. Now, forward looking for us for the returns there, we think that there's some good support, good opportunities, and so that would include within it the umbrella of India. So we're favorable on that area. But the areas that we're a little bit more interested in, mainly because they have much lower valuations because they had some rather extreme political issues, would be more looking at Latin and South America, and then the Middle East and North Africa. We know that the Middle East and North Africa, that you had issues in South Africa and in Turkey and in the Latin America and South America area, as far as some issues with both Mexico, but then also with Brazil. From a valuation perspective, those areas look a little bit more attractive. So when we kind of look at the combination of valuations and then momentum, it really leads us to take a more balanced approach, but really favoring a little bit more of a bias towards Latin and South America, because we think that the trend is beginning to change there in favor of some more strengthening, where that valuation gap that we see between Asia and then South America can close a little bit. But we still are positive on China and India and that general region.
Okay. Well, I would have liked to end on that note. You're positive on China and India. But just a word more, we haven't seen too much of dollar flows into Indian government securities. I mean, they're yielding a good 6%. The exchange rate has been stable. Why are they not attracting money?
Yeah, if you have the high enough rates, right? If you build it, they will come, is kind of this quote from a movie, Field of Dreams, that was very popular a few years ago, many more years ago than probably what I think that it is. But as far as the higher rates, the question is why are they high? Is it a compensation because of the real rate, or what's the inflation outlook, right? And so even though the currency has been relatively stable, we have seen the inflation rate begin to increase. Now, based on the Bloomberg consensus forecasts for India's inflation rate for next year, it's actually fairly tame, but it is slightly higher than what you see in some of the other areas, like in China, and then also, of course, in the developed world. So I think that might have people a little bit cautious as far as investing in the fixed income markets there, is mainly because of what's the inflation outlook. We know that the central bank has been very accommodative. They seem to be coordinating with the Treasury, but sometimes that can cause some inflation surprises to the upside. And so I think that might be one of the reasons why investors are a little cautious. On my team, we don't allocate to debt in specific countries in the emerging market space. We leave that up to individual portfolio managers to do. We allocate more broadly to emerging markets or not, or within emerging markets, the broad regions. And I know that the outlook is one where there are some concerns about, they almost want to wait for a little bit more clarity as to what the inflation picture is before they commit capital.
All right. Brian Jacobsen, it was a pleasure speaking with you. You want more clarity on the Indian macros, on inflation. You probably should sit on and wait for our next interview. Thank you very much, because joining us next is the DEA Secretary, Department of Economic Affairs Secretary, Mr. Tarun Bajaj, for probably his first media interaction after he took over. Very important person as far as the Indian macro policy is concerned. To keep it with CNBC TV 18, we have Mr. Tarun Bajaj joining us.